Good evening, everyone, and welcome to the webinar session that we are going to start from today over the next 6 sessions. That is going to be pure derivatives. This is a special session of a special series of webinars that we have started for all the people who are new to the segment and who wants to have a sound knowledge about derivatives segment and its uses and to understand why to trade in derivatives, what is it exactly, and how do we start. So, before we start, let me just introduce myself. I'm Shilpa Raut, looking after the derivative desk for Prabhudas Leeladhar. All the trading calls that you get on daily basis through Telegram, through WhatsApp, or through mobile app, which comes as in PL derivatives, is something that is sent from my desk. So, and if anybody has been following, and they must be knowing how aggressive we have been with our desk and what has been the past performance. So, in that regards, we have started a fixed session of webinars to make more people aware about derivatives market, its segment, and how does it actually help everyone to to optimize their earnings in the same participation and getting a leverage more than the equity or the cash market, and hence how to go ahead with it. So let's get started. So, what is derivatives first? Many people who are new here are always in doubt, what is exactly derivatives market? Because everybody is aware the stock market and there's one this cash market where you have to whatever capital you have to invest in full to have whatever stock and whatever portfolio you want to build. Let's say you want to buy Reliance 1,000 shares and the price is quoting at around 1,450 to 1,500. Then you have to have 1,500 into 1,000. That's a day of 1.5, that's 15 lakh rupees of the margin of the capital to go ahead and invest that amount. But here, what happens with derivatives is that you only have to pay a minimum amount, which makes you eligible to participate in the stock market completely without without actually having to completely have that full margin required to participate if you are doing in the cash market. So this is one very key feature as to why then people you go for derivatives market. Okay, there are many people requesting me to also speak in Hindi. I will definitely do that as well. So whatever I've said just as an introduction to derivatives, I'll just speak one line in Hindi also for the people to have a grasp of what is going to happen in the session. डेरिवेटिव मार्केट एक ऐसा मार्केट है सर जिसमें आप लोगों को पूरा अपना इन्वेस्टमेंट मार्जिन लगाना नहीं पड़ेगा. लेट्स से आपको रिलायंस खरीदना है 1,000 शेयर और रिलायंस का प्राइस अभी 1,500 रुपए चल रहा है, तो उसके हिसाब से आपको 1,500 इंटू आपको 1,000 शेयर के लिए जो भी आपका कैपिटल लगेगा एंटायर मार्जिन आपको देना पड़ेगा टू बाय दैट कंप्लीट स्टॉक अपने लिए. लेकिन डेरिवेटिव्स में इफ यू हैव, अगर आपके पास आपके पूरे मार्जिन का जितना रिलायंस के लिए चाहिए होता है 1,000 शेयर खरीदने के लिए उसका 20% भी रहेगा, देन ऑल्सो यू आर एलिजिबल टू पार्टिसिपेट इन दैट मार्केट. Okay, so let's get started. So what is derivatives? Derivatives are financial instruments जैसे हम लोगों का जिसका एक whose value is derived from an underlying asset, equity, forex, commodity. Derivatives market में okay, am I eligible? I mean, am I audible now? People are complaining about voice. Am I audible? Please, anybody can write me so that we can know we can continue. Thank you so much. Okay, what is derivatives? Derivatives are financial instruments whose value is derived from an underlying asset, let's say equity, forex, commodity, etc. There are basically 4 types of derivative contracts, which are forwards, futures, options and swaps. But only futures and options are the only standardized contracts that are practiced. It offers high leverage and hedging possibilities. Yeah, and even a non-trader who is not very active into this segment, if has a brief idea about what the segment is, can also participate in the market without any problem, without going wrong. So whatever is there written in this slide, I will try and explain in a very simpler form to everyone who can understand what is derivatives and how to actually make reap benefit out of it. So like we've said, what is derivatives? The derivatives, we actually use, as a tool for hedging against price fluctuation. It gives you a loads of leverage. Liquidity is very high in derivatives. And like I said, if you have 20 to 25% of your margin also available with you, then also you can participate into this market completely. So before understanding, going forward into this in detail, we need to understand the key difference between cash and derivatives. So what is the key difference? In cash, we need 100% payment to go for any buying or selling of your portfolio or any stock you want to go. But in derivatives, you only need, let's say, 20% of the entire margin required, and you can participate in the market completely. In cash, the main benefit is that whatever you buy or whatever portfolio you hold, the ownership remains with you until and unless you have squared off your positions. There is no time limit to what you want to do when you're sitting on cash market. But in derivatives, it doesn't happen that way. Because derivatives, what happens is that we are holding that ownership of the position or the stock that we have bought till we square it off, or at least till the last Thursday of the contract month. In derivatives, there's always contracts that we practice, and these contracts are always they are about these contracts always expire on every last Thursday of the month. So that is the time when we have to square it off, or if before, suppose we have our own conditions and we meet that, then we square it off. In cash, we can go for any quantity. We can go for even one number of shares or 100 number of shares or 1,000 number of shares. But in derivatives, it is not like that. One has to buy uh, any the lot size. There are few lot sizes available in derivatives market. Like I was giving example of Reliance. Reliance, if you want to buy one share or 5 shares or 100 shares, you can do it in cash market. But in derivatives, Reliance lot size, which is a mix of 500 shares, is equal to one lot size in derivatives. So in that case, one has to go for this lot size. You cannot just single-handedly buy your desired number of shares. You can buy desired number of lots, 500 shares of one lot. So you can go for 2 lots or 3 lots or one lot. That is completely up to you. But it cannot be individually shared. In cash market delivery is to be given or taken. But in derivatives, there's nothing like delivery. We have instruments available to trade, like index futures, stock futures, index options, and stock options. Index futures are completely nifty, bank nifty futures that we deal with. Stock futures, individual stocks that we have in derivative segment. There's a list of stocks available. Not every stock is listed in derivative segment. So those are stock futures, index options, and stock options. So this is how derivative market work. Okay, somebody is asking me what's squaring off. Squaring off, like I said, if you're holding a position in derivatives, let's say Reliance, and you are holding, you bought it in May series now. May series expiry is due on 28th of this month, because that's the last Thursday of the month. So either you square off your position before 28th when you meet your criteria, whether you are on the buying side or the selling side, or it will be automatically squared off if you don't roll over on the last Thursday of the month. I hope that is clear. Kinjal. Lots actually means, like I said, 500 shares is equal to one lot for Reliance. So likewise, 8,000 shares is compiled to be one lot for NCC. So there are number of shares that are compiled as lots and are presented to you in derivative segment. Rollover and all, we will definitely come to that, but in coming sessions. Uh, Today is let's start from the ground level. As I can see, many people have been asking too many questions. That means that derivatives is completely a new segment here. So I'm very glad that we will be uh, taking it forward this way. Okay. Like I said, whatever I told you about derivatives, what are future contracts, I will try and explain in a very simple way. So here's an example. Please follow it very carefully. It will be very easy to understand. Suppose there's a farmer who wants to sell his harvest for a future day, eliminating the risk of fluctuations of the harvest for a future day. Let's say आप farmer हो and you आपने कुछ जो भी आपका हार्वेस्ट है, चाहे वो चावल हो या कुछ भी हो, आपने उसको खरीदा हो, आपने उस पे बहुत मेहनत किया हुआ है और आपने उस पे अभी इन्वेस्ट किया हुआ है. So what happens that you want to sell this whatever harvest you have today for at a future date, because you are unaware कि आपका जो भी harvest है, अगर आज let's say 100 rupees है, going forward it might not be 100 rupees at a future date. Let's say after a month you will sell your harvest, but in that scenario it may not be 100 rupees, it may be 90, you think. So what you do is you want to sell it from today, because today the price is right and you think अगर इसी price पे आपको आगे भी मिल जाएगा, then you will make benefits. So what in this scenario, what do? You find someone, let's say Mr. X, who's willing to enter into an agreement with the farmer. Let's say you go into the market and you find someone and who is willing to take your harvest from today. It's not yet reaped, but he's willing to take the risk of your harvest from today, and he enters into an agreement with you that he will buy your harvest at 100 rupees after a month. Then what happens? You both, a farmer and Mr. X, they both enter a contract, which is the future contract, which we do in derivatives. And the price of the harvest is based on the spot price. Spot price matlab in the market, in the cash market that is running. So whatever contract they did it on the present market rate. So they entered that contract. So here what happens? The farmer is the hedger, which we do in derivatives. The farmer, eliminating his risk of price fluctuation, is securing his investment, his labor, and his harvest from day one only, and not waiting till the month end to know what will be the price later. And here, Mr. X is the speculator. Why speculator? Because he understands that he's taking a risk. He's buying your harvest from day one, whether not knowing what will happen after a month. It might be 95, it might be 90, it might be 130 as well. So he's willing to take that risk. So this is how the future contracts work. This is derivatives market. There's one hedge, there's a person who hedge, there's one speculator, and whatever contracts that are exchange are the future contracts, and the price value of derivatives is always derived from the spot price. So let's say now understanding what is derivatives actually working, how is it working. So here's one example too. Let's say you are into a horse race. So if you want to participate in horse race, what do you have to do? uh, you uh, you have to buy a horse, you have to guide him, train him, make him eat, make him eligible for that race. Then only you may be able to bet and you may be sure of what is going to happen in the race. But in if you are dealing with derivative segment, you only have to go and you only have to participate in the race by only paying the bet amount and not completely buying the horse. So I hope everybody is clear on what is this expiry, why am I talking about this expiry thing, and owning the stock in derivatives by only paying 20%. This is the example. if you are in a horse race and you are only giving the betting amount and you own that horse till the race completes, you are only investing a minimum amount. You are not completely buying the horse and taking care of the horse and training and guiding him in everything to go into the race. So this is how derivatives works. You only pay 20 to 25% amount of the entire margin required to own any stock, and you are participating and owning that stock completely till the expiry or till the time you square it off. So this is how derivatives market work. I hope this is completely simple and easy to understand. And whatever questions we have, we will definitely try and answer each one. But going forward, right now, please let's understand. So, what are options? In derivatives, there are two types of contracts we practice. One is futures and one are options. So anybody who has minimum idea about derivatives also will understand that must have heard these two terms: future contracts and option contracts. Future contracts we discussed. Now coming to options. What are options? Option contract is again a financial derivative that represents a contract sold by one party, the option writer, which we name them, to another party, which are the option holder. So why options also? Let me tell you one thing. If when we are discussing that derivatives is a leverage product and under derivatives there are futures and options. If futures dealing with futures is a leverage because you only need 20 to 25% of your entire margin required in cash. Options are far more leveraged. You only need maybe 20 to 25% of the future margin required. I mean, that comes up to nearly negligible amount if you are only a trader in cash markets. So option is something too leverage for those people. So what are option? There are two types of option. One is buying option buyer and one are option seller. So option buyer are what? They pay the premium. Like I said, the minimum, the investment required in options is very less. It's very negligible. So whatever we